The StoneX Agricultural and Industrial Markets Outlook Conference for 2026 is coming up soon and taking place in Cartagena, Colombia on February 18th, 19th, and 20th. It's an event that brings together experts from around the world to break down the major forces shaping global commodity markets, from grains, sugar, meat, and vegetable oils to metals, carbon credits, and even digital assets. One force cutting across all of these markets is carbon regulation, which is increasingly influencing pricing, trade flows, and even how commodity contracts are structured. From carbon border taxes to shipping emissions rules, traders are now having to price carbon as they do for freight, volume, and quality. To explain how these regulations are reshaping international commodity trading and what market participants need to be thinking about next, I'm joined by Alfredo Nicastro, Senior Vice President, Global Head of Carbon Markets at StoneX. Welcome, Alfredo, and it's nice to properly meet you.
My pleasure, Johanna. Thank you so much. It is really great to be here, and you're absolutely right. Carbon regulation has rapidly shifted from purely compliance topic, to a real commercial driver in commodity markets, affecting not only pricing but also trade flows and risk management. So this discussion is very, very timely.
It is. In fact, many are now calling carbon regulation a new kind of trade tariff. So, how is it changing the way global commodities are traded?
Look, that's an interesting point. Originally, carbon markets were designed as a financial tool to support investment in climate action. As regulation evolved and expanded, carbon has started to behave very much like a traditional tariff because it directly increases the landed cost of carbon intensive commodities and products. The key difference, I would say, between the carbon costs or tariffs or whatever you want to call it,
Hmm.
from a traditional trade tariff is that the cost is variable. Two cargoes, for an example, of the same commodity can have very different economics depending on where and how they were produced. For traders, that means carbon intensity becomes a pricing input alongside freight and quality. And if not priced correctly at origin, it can quickly erode margins or remove arbitrage opportunities altogether. That's a tricky topic actually.
So then, would you say that measures like the EU's CBAM actually changing where commodities are sourced and how they move around the world?
Oh, definitely yes. CBAM, for an example, is already influencing trade flows even before full financial settlement starts in January 27. Buyers into the EU are becoming more selective about sourcing, of course, favoring products and producers with lower carbon intensity or stronger emissions data. So over time, this reshapes flows by penalizing high emission supply chains rather than blocking trade outright. It also increases the importance of emissions transparency alongside traditional origin and quality considerations, and definitely encourages investment toward cleaner production regions.
I see. The shipping industry is also coming under tighter carbon regulation. What does this mean for freight costs and delivery risk in commodity markets?
This is a very important aspect that often goes unnoticed until it hits the trading costs, of course, right? So shipping decarbonization is changing both freight costs and delivery risk. The inclusion of shipping in the carbon schemes like the UETS adds a new layer of costs to voyages, which is not always predictable, but ultimately gets built into freight rates. Older or less efficient vessels become less competitive, of course, which can tighten effective vessel supply. As a result, freight is no longer just about distance and speed, it's also about emissions efficiency. And that adds more volatility to delivered commodity prices.
So, then, given these carbon related costs and potential uncertainty, how should traders and producers adapt their risk management strategies?
Well, traders and producers should definitely treat carbon risk as a core commercial risk. That means that you should be building carbon adjusted pricing models, be doing stress testing exposures, and clearly allocating carbon liability into contracts. We're also starting to see carbon price hedging become part of broader risk management strategies,
Hmm.
whether through allowances or credits or structured commercial arrangements. Alongside that, traders are prioritizing relationships with suppliers who can provide reliable emissions data. Ultimately, carbon risk is increasingly sitting alongside price, freight, and counterparty risk in day to day trading decisions. So, no longer just a compliance matter.
I was going to say, I think it's fair to say then that carbon isn't just a compliance issue anymore. It's now a strategic advantage. So, as regulation continues to develop, what should traders prioritize?
Look, I would say that looking ahead, carbon will increasingly differentiate winners and losers in commodities traders, right? So, in commodities trading. So, key things to watch are the expansion of carbon border mechanisms beyond Europe and beyond CBAM, right? Tighter integration between physical markets and carbon markets. So we see demand coming from the supply side, criteria from buyers saying, look, for me to buy your product, you need to comply with this kind of rules and regulations. So that's the play between the physical and carbon markets and growing demand for certified low carbon commodities. Traders who act quickly and first, I would say, develop strong carbon intelligence from data to contract design will be able to protect margins and create pricing advantages rather than simply react to regulation. So carbon is no longer just a compliance cost. It's definitely becoming a core driver of trade economics and an aspect of competitive positioning in global commodities markets.
Understood. Alfredo, thank you so much again for your time. And thank you to our viewers for watching. If you'd like more information about the conference, just scan the QR code or click the link in the description below.